Every headline right now seems to tell a story of instability. The market goes up, the market goes down, and with each swing, a sense of unease can settle in. For those who have spent decades building their wealth and are now approaching or living in retirement, this volatility feels like more than just a headline. It feels like a direct and genuine threat to the capital you depend on. The conventional wisdom often whispers that the only safe harbor is to pull your money out entirely, to retreat to the perceived safety of cash and wait for the storm to pass. This reaction is understandable. It's a natural human impulse to protect what you have built from a threat you cannot control. Most people approach this period thinking the primary goal is to avoid any and all market risk. They believe that preserving capital means exiting the very engine that helped create it. That's not the part that actually matters most. The strategy we will discuss is called the anchor portfolio. The name itself conveys its purpose. It is not about timing the market or finding the next high-flying stock. It is about dropping an anchor to provide stability in choppy waters, to protect your accumulated capital from severe downturns, while still allowing a portion of your wealth to generate moderate, secure growth to sustain you through retirement. It's a method built on balance and structure, not on speculation or reacting to the daily news cycle. The goal is to create a sense of calm and control, even when the world outside feels chaotic. This framework is most beneficial for a specific type of investor. If you are within 10 years of retirement or already retired, at this stage, your financial horizon has shortened. You no longer have decades to recover from a major market correction. A significant drop in your portfolio's value can have a disproportionately large and lasting negative impact, especially if it happens just as you begin to make withdrawals. This is a mathematical reality known as sequence of returns risk. It is the central problem the anchor portfolio aims to solve. The tone of our discussion will be one of calm authority. This is not about motivational hype or get-rich-quick schemes. We will proceed with a measured and intentional pace, much like an experienced advisor would. The concepts are strategic and steady, focusing on clear thinking and durable principles rather than fleeting tactics. The aim is to empower you with a clear understanding of a system that lets you sleep better at night, because it is built for resilience, not for speed. We will break down the 4 simple components that make up the core of this strategy. Each piece has a distinct role. Together, they form a cohesive whole that balances safety and growth. You will learn how to structure your assets to create a buffer against market shocks, ensuring your near-term income needs are protected. At the same time, you'll see how to keep a portion of your wealth working for you, generating the returns necessary for long-term financial health. This is about building something meant to last, a financial plan that acknowledges reality and prepares for it with quiet confidence. We have discussed the strategic context. We have defined the components. We understand the theory of why this structure provides resilience. Now here's where this becomes practical. The real strength of any financial strategy is not in its intellectual elegance, but in its real-world application. This is the distinction resilient investors understand. They build systems, not just hold assets. Before we go further, this next part matters. It's where we translate the blueprint into an actual plan. Shift your perspective from one pot of money to 3 distinct buckets, each with a specific job: cash, anchor, growth. This mental separation is the foundation for disciplined decision-making. A drop in the market is now just a temporary event in one of your buckets, the one you don't need to touch for a long time. This approach simplifies your choices. Actions are guided by the level of funds in each bucket. The system tells you what to do. This removes the guesswork, and it removes the emotion. Let's walk through a practical, real-world scenario. Let's meet Eleanor. She is 62 and just retired from a long career. she determines she needs $75,000 per year to live comfortably. Next, she accounts for her guaranteed income sources. She will receive $25,000 per year from Social Security. This means the amount her portfolio must generate each year, her income gap, is $50,000. With her annual need established, we can now size her first line of defense, the liquidity buffer. We decide on a 12-month buffer. The calculation is simple, exactly $50,000. This amount will be moved into a high-yield savings account. This initial step is psychologically powerful. She knows that for the next 12 months, her income is completely secure. Now that the liquidity buffer is set, we move to the core of the strategy, building Eleanor's anchor. Given Eleanor's moderate risk tolerance, we decide on a 4-year anchor. 4 years times $50,000 equals $200,000. That $200,000 is allocated to extremely safe, stable assets, like a CD ladder and a short-term government bond fund. In total, she has secured her income for the first 5 years of her retirement. This is a profound shift. If a severe bear market were to begin tomorrow, it would not impact her lifestyle or force her to sell her growth investments for 5 full years. After setting aside the buffer and the anchor, Eleanor is left with $950,000. This forms her growth sleeve. This is the engine of her portfolio, designed to generate the long-term returns necessary to outpace inflation and grow her capital. For the allocation, we choose a simple, globally diversified portfolio of low-cost stock index funds. A sensible mix might be 60% US and 40% international. This provides broad exposure to thousands of companies, harnessing the power of the global economy. It is about patient, diversified ownership. Now, Eleanor's complete anchor portfolio is assembled. This allocation is not an arbitrary split. It is the direct result of a needs-based process. Her rebalancing rule is simple. At the end of a good year, she will sell just enough from the growth sleeve to refill her cash buffer. Let's test the plan. Imagine in year 2, the stock market falls by 25%. This drop only affects her growth sleeve. Her $950,000 falls to approximately $712,500. Her anchor's value remains at $200,000. What does Eleanor do? She follows her rules. For her income, she draws $50,000 from her stable anchor. She does not touch her growth sleeve. She has calmly funded her lifestyle without selling a single stock at a loss. Her system has absorbed the shock exactly as designed. The system allows her to act with the calm authority of an experienced advisor. She is not just surviving the downturn. She is navigating it with a clear, resilient plan. The anchor portfolio is more than just an asset allocation model. It moves the goalpost from chasing the highest possible return to achieving the highest degree of resilience. It builds a firewall between long-term capital and short-term needs, so a market storm does not have to become a household crisis. Ultimately, this strategy is about control. Control the variables you can, your spending, your asset structure, your rules, and build a buffer against variables you cannot control. The peace of mind from that structure is often the most valuable return. The anchor portfolio should be viewed as the foundational structure upon which a comprehensive retirement strategy is built. The core idea is that good financial planning is a process of layering one sound decision on top of another. This concept of building a complete and resilient system is what we focus on at this channel. The ideas are designed to connect and build upon one another. If you're building something meant to last, the next video on this channel builds directly on this idea.